Join us now to talk rates. Subadra Rajappa, head of U.S. rate strategy at Societe Generale. And I didn't see you nodding, but I read your notes, and I felt some implicit nodding. There are big supply issues and not necessarily receptive buyers on the other side of a lot of debt issuance coming up. Absolutely.
I think the supply-demand dynamics are definitely as skewed as they've ever been in at least the last decade or so. Yes, foreigners have been stepping back. China is not buying nearly as much, and then Japan is also not buying, as much. In fact, they've been selling treasuries. But really, the elephant in the room for me is the Fed. They've been unwinding their balance sheet, and it's QT. They've been unwinding the balance sheet at the rate of $100 billion, per month. And then you have banks and financial institutions also reducing their portfolios after the regional banking crisis. Banks have been reducing their treasury holdings. They have a lot of unrealized losses in their portfolio. Yeah. So they really can't grow their portfolio in a meaningful way. So there's a lot of reliance on real money accounts in the U.S., as well as money market funds and hedge funds. So that's really where all the money is going, as opposed to international buyers or the Fed.
And it's kind of, we've talked about it and pointed it out because it's not, you don't think about it necessarily. It's kind of a vicious cycle because the higher rates are going, the more things cost, which makes inflation stay high, which makes rates stay high, at least stay higher, might even go higher from here because of those things. It kind of feeds back on itself, doesn't it?
The way I look at it is the higher interest rates go, the more the chances are something else will break. Right now, you're seeing, overseas BTP bond spreads are widening. Emerging markets are going to come under pressure as yields rise. Our equity strategists are thinking at 5% as the threshold for when equities might start coming under pressure. So the borrowing costs in general are going up. The mortgage market is under a lot of stress.
So the soft landing idea doesn't really work in your scenario.
I think orchestrating a soft landing is going to be quite hard. I mean, the Fed's really not succeeded in doing that, in the past.
Ever. No, maybe, I don't know, maybe I can't think, maybe if you go back, like Teddy Roosevelt, or was there a Fed? No, it was 1912 or something, wasn't it? Yeah,
I'd say in recent memory, it's mostly been in the 90s where, they raised aggressively in the early 90s. They cut a couple of times in the mid-90s. Again, you had the LTCM crisis where they cut rates by 75 basis points. And then we continued to expand until, the equity market and the tech bubble in 2000.
Could the Fed, if the Fed's the biggest problem in all of this, not just the Fed, but other central banks too, but if the Fed's the biggest problem because they're trying to unwind QT, could they stop the problem by stopping the unwinding? Could they just keep QT? For forever?
It's interesting that you would bring that up because, we saw this morning that the Bank of Japan came in and started buying, 10-year treasuries because they didn't want, 10-year JGBs because they didn't want yields to rise quite meaningfully on the back of that. There's to me, it feels like ultimately if there's a huge supply-demand imbalance and treasury yields start to rise meaningfully, then you're going to have to see the Fed step in and buy assets. We saw that back in March.
Because to this point, it's been the bond market that has been pushing rates higher. But, if this is a situation where you just can't sell the debt and the government has plans to issue lots more, that seems like the only way out of it is that the Fed steps in again and says, OK, we're still here to stay.
Yeah, and we saw that back in March of 2020 when we saw this massive spike in yields. The Fed is your backstop buyer if you see a very large rise in yields in the bond market. Right. So that's kind of the scenario I think that would ultimately play out. It's really hard to see that right now because the economy is so strong. The Fed is committed to keeping rates higher for longer, as well as continue to unwind its balance sheet. But I think the ramifications of that are going to be down the line.
So maybe the Fed says, forget it, we're not cutting rates like all of these projections for next year. We're not going to cut rates, we're going to keep them there. But maybe they do easing anyway by keeping the quantitative tightening. And I guess just what does that mean? Does that mean it's not the worst case scenario? We don't go to 7% and beyond. But we're also not going to see lower rates than we see at this point.
So I agree with the point that we don't really see lower rates, in a meaningful way like we saw back in previous crises. I think the decline in yields might be less dramatic this time around if the Fed were to cut rates. But our base case is that the U.S. economy will go into a recession by the middle of next year, and that will warrant some rate cuts. You know, in my view, even if they had to orchestrate a soft landing, they're going to have to cut policy at least, or adjust policy at least a little bit to ensure that they can remain somewhat stimulative.
As we're unable to sell debt, our borrowing costs are soaring, too. I mean, what we pay on what we've already issued. I mean, it's not a great. You had nothing good to say. I was right, Subadra. This is horrible. It's scary.
It is, and I'm still an optimist, and I'm hopeful that we will find a way to reduce deficits over the coming years. There are caps on spending. You know, the tax cuts that were initiated, you know, during the Trump administration are set to expire in 2025. So there are, you know, avenues in which we can kind of try to rein in the debt issue. But it's not imminent or forthcoming at the current time.
All right.